Hello and welcome back to another episode of Fun Friday with a very special guest here, Chris Davis, founder of Davis Capital Partners. How are you today, my friend?
I'm doing very well, Craig. How about you?
I'm doing well, thank you. It's fun to have a conversation with you again and get you on the podcast. I remember when you were kind of just getting, I think, into the space and learning about more about syndication. And you've obviously very quickly have raised a lot of money, been a great partner to many sponsors, hopefully soon to be Lone Star in the not too distant future. But would love to learn more about your story, your kind of background, how you got into this space, and all things in between. So without further ado, would love to hear kind of the background and how you got your start.
Yeah, thanks so much for having me on. I'm Chris Davis, Davis Capital Partners, originally from Kansas City. Grew up in Northwest Arkansas, one of the most thriving real estate markets in the country. I have an amazing 8-year-old daughter named Lily. She's the most important thing in the world to me. We have a ton of fun, mountain biking, camping, fishing, kayaking, swimming, hiking, all the great things that Northwest Arkansas offers. And Northwest Arkansas is actually the mountain bike capital of the world now. So over almost 400 trails of 400 miles of mountain bike trails.
That's incredible.
Yeah. You ride any out there?
Not much now here. I got my road bike not too long ago. I like to go through the
Yep.
neighborhoods every now and then, but it's nice to have that. And it seems like we've got a lot of common because my
Yeah.
hobbies are all inclusive to being outside, essentially, whether it be golf, kind of hiking,
Yep.
biking, so on and so forth. I need to be outside and, get sunlight on.
Absolutely. Me too.
Yeah.
I've got a gravel bike and a mountain bike. So a little bit of both road and off road.
Excellent. Yeah. So you have that there, and then you've been in the commercial service business and customer service business doing sales for quite some time, have you not?
Yeah. So, overall 30 years in customer service, starting way back to working in my family's dry cleaning business, sweatshop, to waiting tables and bartending through college. And then I've spent the last 20 years in finance and real estate. I've been 100% commission based or self-employed since graduating college in 2004. So very entrepreneurial by nature. 19 years mortgage banker, working 60, 80 hours a week in the early years. Survived the Great Recession. It's pretty scary watching the economy, the real estate market, and my income collapse. Had to go back to bartending a couple nights a week just to pay the bills. So you cue the gray hairs here. In 2014, I opened Arkansas's first branch for Cornerstone Home Lending. I grew that to having the most 5-star reviews of any other bank or mortgage company in the state of Arkansas. Did that by building. Excuse me. That was built on the success of world-class customer service, communication, closing on time every time. Craig, I'm sure you can appreciate that from your residential real estate career.
Absolutely. Yeah. I mean, that said, with that there, getting to the mortgage space, riding the highs and lows, it's a pretty difficult thing to do. And getting yourself set up and investing correctly and putting your nest eggs out there is important. And I'm not 100% positive as to how the mortgage base goes, but in the real estate side of things, when you're a realtor, there's not company 401k matching. There's not, kind of retirement plans, pensions, stuff like that. You're an independent contractor. So you really got to educate yourself and take upon yourself to figure out how you can actually have a sustainable retirement, figure out a way where you can put your dollars away and you can set up systems and hopefully passive income setups where you can really be able to kind of take some of that burden off yourself. You can't have a big year and all of a sudden buy a boat. You've got to be thinking about, okay, well, I need to kind of get this money working for me. And that's, I think, the benefit if you're in the mortgage space or if you're, a realtor or in the commercial real estate world, any kind of real estate background like that, you need to be investing and kind of creating that path for yourself. Is that kind of similar to the mortgage world there where, there's not really any hand holding there, if you will, or kind of setups with that?
Yeah, it's 100% commission based, and there is usually a 401k with matching, but that's pretty much it for the retirement piece. And when I first got started, mortgage lenders were 1099 when there wasn't any 401k with that. And lesson learned: be sure to put money aside for taxes. So when you're first getting started, right? You have a decent year, and then oh my gosh, I got to pay 40% in taxes that I didn't set aside. So and then yeah, with any real estate mortgage, yeah, with for independent contractor, real estate agent, a great option for retirement is a self-directed IRA or 401k, and you can actually use that self-directed IRA to invest into real estate.
Excellent.
So that's a great option.
Yeah. So were you, and if you're in the mortgage world, are you a 1099 employee or are you technically a W-2?
So I was 1099 to start. Most loan officers were back then. And then 0809 happened, right? And then there was a ton of financial reform, Dodd-Frank Act. And then it basically required loan officers to be W-2 employees.
Gotcha. Makes sense.
So,
So then
and our
transition.
compensation got cut in half.
Yeah. Yeah. I mean, back in the day where you could do 90/10 loans, ninja loans, stuff like
Yeah.
that. I mean, it's funny if you watch the Big Short movie, it kind of gives you a little bit of an education as how the world used to be in that regard.
Yep.
Now there's a lot more regulation. It's super funny. I was working with my uncle and my cousin to buy a house here in Phoenix. This was several years ago, back when I was selling roughly in 21, I want to say, or 2020. And he was shocked by the amount of paperwork that he needed to do in order to acquire and get a mortgage. And from when the last time he got a mortgage was done, it was totally different. It was a world in which, you could kind of give a couple statements and you were good to go. So it's a lot more rigorous now than it was back in the day. Can you attest to that kind of over the time after kind of going through the GFC to what it
Yeah.
had been maybe a couple of years ago or currently?
Yeah. When I got in the business in '04, I mean, there were loans that you needed a driver's license, be able to fog a mirror and, title work,
Yeah.
insurance. That's about it. No appraisal, sometimes no income asset verification. That caused a lot of big problems with borrowers getting loans they couldn't afford, and some people doing adjustable rate mortgages, and not meeting debt to income ratio requirements, and so created a big problem with defaults and overbuilding of housing. Right, it was one of the main reasons for the decline in the real estate market.
It also propped
Uh,
up the market a ton too, because these people, are now new buyers, said kind of illegitimate, or not fraudulent, let's just call it what it is, but people who are able to game the system, get mortgages and buy properties that they likely shouldn't have based on maybe bogus qualifications, propped up a
yeah.
market, props up the market, now there's, five would-be buyers when there's probably actually two. When there's five buyers, we both know pricing starts to go up, the market gets a lot harder, right?
Absolutely.
Yeah. Were you seeing during that time as well? I mean, loans just kind of flying. And could you, like, when you got into it in '04, was it pretty hot where everything was kind of selling? Everyone was trying to get a mortgage at that point. And then what was it like when kind of the roller coaster at its peak and it started to come down? When the market started kind of crashing, coming down, can you maybe walk through some people who didn't live through the GFC like myself from a working perspective, who don't have a historical context to maybe compare it to what it's like now, perhaps? Like what was that experience like going from a hot market where everything is selling to, oh my God, things are basically cutting in half on the pricing and value?
Yeah, when I got in '04, it was a pretty hot market, active mortgage market. There's some refinancing going on, purchase, and then '08 '09 happened, and Lehman Brothers and these huge established financial companies just started to collapse, and it created a screeching halt to the real estate market. Values declined, quite a bit. I actually had to go back to bartending a couple nights a week to pay the bills. And then, the Fed started printing money, quantitative easing, and brought interest rates down, right? So uh, mortgage rates track the yield on treasury bonds, right? And so the Fed can't set long-term mortgage rates, but they can influence by printing money and buying billions of dollars worth of mortgage bonds. And so that's what they did. And that dropped interest rates below 5% for the first time in history, right? So they started tracking in 1971. Rates were about 7.5%. In the 1980s, they got up as high as 18. And from 71 until '08 '09, rates were always above 5. So when rates hit that 5% threshold and below, there was a refinance boom. So we were able to Even though the purchase market had stopped or stalled, we were able to do a lot of refinance loans to pick up that production side and survive. And then the real estate market came back and purchase loans picked back up.
Right. Was it pretty, I guess wild where all of a sudden, when you're going through it and working with clients where, the bid ask spread, if you will, the purchase price to where people wanted to pay were pretty far apart. What was your experience on that front?
In what time frame? Like what years?
Like I guess during the GFC, the peak of it in '09, maybe to '08 to
Yeah.
maybe 2011 or so.
Yeah. I mean, people were just afraid to catch a falling knife, right? I mean, everyone wanted to wait and see when the bottom was going to be. So there was just a big disconnect. Everyone was on the sidelines, just waiting.
Yeah. Would you say there's any parallels to when that was occurring? Maybe not on the home side, but on the multifamily side of things, as we look at what's going on today?
Maybe, I didn't follow multifamily back then. Um, but, there has been some, declines in major markets, right, with an oversupply, which is the exact opposite of 0809, right? So 0809 was an oversupply of homes. Um, and now we're in a shortage of housing, with, interest rates had gone up so much over the last, or rents had gone up so much over the last few years. They're kind of flatlining now to declining because of new construction hitting the market, right, and concessions, and that's starting to burn off, right. So we're seeing a record number of new construction deliverables hitting the market now, but that there hasn't been any new permits the last couple of years because of the rapid rise in interest rates. So the new supply hitting the market is going to be thin, more forward in the next couple of years. So rents should stabilize, and we'll see the rents start to increase again.
Fair enough. So let's transition back into some of your real estate investing and whatnot. Going back to your real estate investing world, you mentioned you're obviously in the mortgages side of things, and I imagine there were some wins and losses along the way from your career and journey there. But can you maybe talk about how you got into the real estate world from an investing side outside of the mortgage side of things?
Yeah. So along my mortgage career, I was investing in single family homes as a side hustle, right? So that was my plan was to build a portfolio of single family homes, get them paid off. That's my retirement. Give that to my daughter one day when I pass. And then I realized, like most investors do, single family homes cash flow $200-300 per door, which barely covers turnover, maintenance, repairs, right? I did have the flexibility of a commission based career, and work on my own schedule, which allowed me to, I had to basically self manage those properties, because there wasn't enough cash flow to pay a property manager. Um, but then, yeah, so, most investors start single family and then they realize that the true path to financial freedom is multifamily, right? The ability to scale, uh, scaling in both income and in better expenses on the properties. And
Yeah. So
yeah,
when you go from, single family and stuff, were you flipping houses? Were you basically buying and holding? What was kind of your route and path there?
yeah. So primarily it was just buy and hold, um, more turnkey properties, right? I was so busy with mortgage, I didn't really have time to renovate. I did some house hacking, right? So primary conversions to investment properties. So I turned my passion and hobby of investing into a full time career, almost 2 years ago. Some of the things I love, there's a lot less stress and drama in commercial real estate, right? So multifamily and commercial real estate operates more like a business. Residential can be, very emotional for a home buyer, right? Lesson learned along the way. Biggest mistake was, flipping a large single family home. Was it, expecting to make, to net about, 80,000 in profit. It went, over budget. It took much longer than expected. There were some title issues that caused the property to sit on the market for a while. or not be able to sell it. And the problem with a single family flip is there's no income while it sits vacant, right?
It's a
And so
massive liability.
lesson learned. Invest for cash flow, not just solely appreciation. Um, One of the great things about multifamily is you're able to renovate the units as annual leases expire, right? So there's no full vacancy risk. If you've got, two or 300 tenants and, as those leases expire, maybe you're renovating four, five, six units at a time. The existing tenants, cover operating costs and mortgage payments, while the business plan is being executed, right? So there's no, you're not draining your personal savings account because the single family homes has been vacant, right?
Yeah, with that, it's kind of interesting. The single family world, I think, now needs to be looked at more of as a true investment, almost like a stock play, if you will. There's expenses there, but it's not really going to give you the cash flow yield that you're really looking for. To your point, the cash flow yield, maybe the appreciation is not as great as a single family would be in a certain neighborhood, as or multi has a little bit more cash flow, maybe less appreciation there. But single family is kind of an equity play. And to your point, some of
Mm-hmm.
the issues when you've got some of these deals in the single family world is just the debt servicing side of things. And if your property isn't able to debt service, if it's basically breaking even, it's a tough situation for a lot of people to be in. And that's kind of why, I think people start in the single family, they want to flip, maybe they want to get an Airbnb in. And then I think a lot of people that come to us quickly learn that, it's more of a job and what's your time worth ultimately, particularly if you're a busy professional and individual.
Absolutely.
Yeah.
Yeah. And so, yeah, I was the sole investor on that flip that lost money. So I've
Can you explain maybe
never
some?
lost a perfect capital.
Yeah, can you maybe explain some of the lessons you learned there as to what you want to do again, as to why that deal kind of went that way? And then I'm sure it's something that you educate your investors on when they're kind of inbounding into you.
Yeah. I bought it in February 2022, right as interest rates started to rise, and interest rates doubled after I bought it. So that was part of the holding cost issue. And then sitting on the market for a while, because the payment had just gone up so much for buyers, right? And so, yeah, I mean, lesson for investors, single family flips can be a drain on resources, right? So if it was at least a 4 unit, or greater, like you renovate 1 unit at a time, the existing tenants cover the payments, right?
Yeah, fair enough. So that was kind of the issue there. Did you just basically you were on the wrong side of the mortgage, kind of the interest rate thing there, and it spiked up, and the market cooled off mid project?
Yeah, it was multiple. Interest rates doubled. The renovation took much longer than expected, right? Sometimes on a single family flip, you don't know what you're going to get into, so you start peeling things back on the renovation, right? So renovation went longer than expected, went over budget, right? So just multiple things coming
Yeah.
together at the same time. So
Yeah, everything Ken piling. Have you kind of told
mhm.
that story to your investors as to, some of the pitfalls as to why maybe the single family world of things, I mean, investing in real estate's great, but getting more specific to it, why, there's another option and route from your kind of negative experience there, if you will?
I need to get the story out there. I've really been almost too embarrassed to share it. So, but yeah, it's a great personal testimony to the difference between single family and multifamily, right?
Yeah. So why, so I guess with that said, what's your thesis as to why multifamily wins as opposed to the single family world?
Well, so you got multiple tenants, right? And you can renovate the units as the leases expire and the units become vacant, which you can control, and so you're able to cover your expenses, right? And if something happens, you can always back off those renovations for a while, right? And just renew leases.
Yeah, you can definitely audible a multifamily plan a little bit more. Like for instance, if you get into a deal
Yeah,
and you're not seeing that the market, potentially is giving you the favorable, rent bump based upon your value add project. Well, assuming if you still bought a good deal, then maybe you just defer that value add project to later on in the market business plan of the cycle of things. Maybe it's not, the first 2 years. Maybe you start doing that in year 3 or 4. And then you sell the property like that
absolutely.
and you don't renovate everything. And then you sell people the idea on the next end of it where, hey, you've got that meat on the bone for the next person.
Absolutely.
Yeah. So you've gone through your personal trials, your issues there, some of the negative experiences. On the personal end of things, you kind of found the multifamily world. I guess how did you get into the multifamily space? Like, was there any sort of content you were watching? Is there any sort of, ad you saw perhaps that kind of hooked you into the world in the space?
Yeah, it really started with COVID lockdown, and started watching a lot of YouTube videos on investing, and it kind of started with Bigger Pockets, and that led me to Best Ever, and listening to podcasts on, or listening to episodes on, scaling and raising capital, and I'm like, man, I wish I would have started deep diving in on this many years ago, right? So I'm buying one or two properties a year, single family, where I could have partnered with other investors and really scaled that up. And so yeah, that led me to best ever conference in Denver a few years ago. Ran into Hunter Thompson and got his book on raising private capital, and that's really where it all started. And so spent a couple of years really deep diving on education. Thousands of hours of podcast, over 100 books on commercial real estate, multifamily, raising private capital, and really just fell in love with it. Was able to sell my single family portfolio, and that gave me the funds to go all in, self employed into the commercial real estate space. And so launched Davis Capital Partners a few years ago. Went full time for the mortgage business 2 years ago, and we're Davis Capital. We're both capital raisers and operators, so we're investing with great operators in great markets, but then also doing our own deals here in Northwest Arkansas. We have two evergreen, customizable, diversified funds. They allow investors to pick and choose which investment to invest in and how much they want to allocate to each investment. Our handpicked opportunities allow investors to generate consistent positive cash flow without the hassles of property management, tenant issues, maintenance, or running a business. We oversee all that for the investors, and then they get the great returns on investment. Our investment thesis is, we target business friendly, high growth markets with strong job and population growth.
You're good.
We invest with the best operators in the best markets in the country. We're currently invested in Northwest Arkansas, Texas, Florida, and the Carolinas. Our core assets are multifamily. Our targets in the 1980s or newer. Value add opportunities. We can go in and renovate the interior, exterior, increase the income, decrease expenses, increasing that net operating income, which exponentially increases the value of the property. I also love RV parks, mobile home parks, self storage, industrial. So the funds allow all those asset types. So we're looking to add those assets this year as additional diversification for investors. Our typical investment structure: $50,000 minimum investment, 8% preferred return, pretty standard, right? So the investors get the first 8% of profits before there's any split with the operator or fund manager. Pretty standard splits are your 70-30 or 80-20, right? So 70% going to the investors, 30% going to the fund manager or operator.
I have a question for you here. So a lot of people are obviously, I understand appeal to Texas, to Florida, and the Carolinas. Those are pretty common markets. And I've heard great things about Arkansas, Fayetteville, so many good places that are in that state. There's obviously a lot of growth there. But in your words, from your experience living there, can you kind of give everyone some knowledge onto the Arkansas area? Because I think it's maybe a little bit skipped over. I hate to say it, but when you look in that region, a lot of people go to Texas, a lot of people go to, let's say, Tennessee, but Arkansas. Can you kind of give the pitch
Yeah.
there and what you love about it?
Yeah. So I grew up in Fayetteville, went to Fayetteville High School, University of Arkansas. and just seen tremendous growth and change over the years. So we're home to Walmart headquarters. All the Walmart vendors have to have an office here. So thousands of, you think, Hershey's, Colgate, Gillette, all the major brands, Tyson Foods, and then JB Hunt Logistics. So you got three Fortune 500 companies in a metroplex that's currently about 500,000, estimated to be over a million in the next 15 years. So very high growth, diversified economy, diversified employment, low cost of living for the most part for such a high growth area. Lots of outdoor great things. Largest greenway in North America, like 36 miles trail. Yeah, so it's been a well kept secret for a while, but now it's hitting national attention. So we're seeing I'm competing with investors in New York, cold calling owners of multifamily properties in Northwest Arkansas.
Right.
Yeah, I had underwrote a deal last year, 56 units, offered 4.8. Some guy out of New York offered 4.85, and so $50,000 on it. 1%. The
Brutal.
kicker was he went 50,000 hard day one, and I had of course due diligence period for inspection. So he won the deal, and yeah, there's a lot of competition here now in Northwest Arkansas for properties.
Is it crazy?
And it's getting to be almost as expensive as.
Yeah. Is it crazy for you to see all the growth and the development in, the Arkansas area and that market particularly, considering how long you've been out there for?
Yeah, it's been tremendous. Northwest Arkansas is consistently rated one of the top 10 places in the country to live, and so yeah, it's been pretty wild to see all the growth and development, and it just continues to grow.
Yeah. Amazing. So let's get into some of, the assets you're in. So multifamily, that one's clear. RV parks, mobile, RV mobile home parks, self-storage, industrial, kind of what you're looking for, as you mentioned there.
Mhm.
So when it comes to RV parks, are you doing those deals in your backyard in Arkansas? Are they kind of all throughout? Do you go through the fund model? How do you look for, those opportunities?
Yeah, looking to partner with some operators that really specialize in that asset class, right? So um, different markets. Be great if there, an opportunity comes up here, but there's a lot of other great markets and great operators. So um, looking for those opportunities, those connections, RV operators in great markets.
Yeah. And then, with regard to self-storage and industrial, do you have any kind of thought or thesis on there, or is it just kind of a diversification play with amongst the commercial sector?
Yeah, diversification play. Self storage is very low maintenance, right? It's a metal box with some lights, and HVAC sometimes on some of the units. So very low maintenance. And then industrial is great with long term triple net lease tenants. That's covering all the maintenance and repairs, and writing very long leases. So the benefits on those for
Yeah,
sure.
certainly. So let's get into the power diversification and kind of we've talked about this before, but what is your thought on that? And obviously, the world now of alts is getting becoming more popular, where alts won't be so alternative in the near future, right? But what is
Yeah.
kind of your thought and kind of overarching view on the power of diversification?
Yeah, it's interesting. I actually went to college and got a degree in finance with the emphasis in investment financial management. And my original plan was to be a financial planner, stockbroker. And I ultimately found that it was hard to trust the stock market. Right? It's interesting. The mainstream media and financial planners, teach you to invest in stocks and bonds. Right? The classic 60-40 portfolio. They say that that's diversified portfolio. I find that a diversified portfolio actually includes some hard assets like real estate, right? So we love the tangible hard assets. The ultra wealthy invest differently than the average investor. So they invest 22% in stocks, 8% bonds, and then 58% alternative investments. Within those alts, it's average 26% real estate, and then 28% private equity. Like say you don't have to be ultra wealthy to invest like one, right?
Yeah, it's super cool that that's more accessible now. And I think there's more information, education on these, private placement deals. And I think particularly
Yeah.
with, working with people, finding individuals, you don't even have to be an accredited investor. You can work in a 506B opportunity and develop the
Hmm.
pre-existing relationship, which is very crucial.
These investments used to be, country club, word of mouth. There was no advertising allowed. The Jobs Act of 2012 really changed the game, and the SEC basically says you're allowed to advertise these type of investments as long as it's to accredited investors only. So that's where most investments fall with that accredited investor requirement.
Makes sense. So, how do you look for partners, from a vetting perspective? What are you seeking, on your end? What are some green flags and red flags that you typically have, and how you go through your kind of evaluation process?
Yeah, so looking for established operators, track records very important, of course. Um, have they lost investor capital? If so, how do they handle that? Have they done capital calls? Um, have they been through a recession before? Can be important. Vertical integration, like Lone Star Capital, is a great one, right? So the ability to control the management, the property management, and construction management, the ability to control the asset management.
Yeah, excellent.
Another great one. And then also when you invest in a typical 5-year hold, you're kind of married for the next 5 years. So it's important to work with people that like, and trust, right? Operators that communicate well. That's really important. Had some experience with one operator that hasn't communicated well, and it's very frustrating. So yeah, investing with folks that are responsive is very important to me.
Yeah, I mean, it's to that point there. The first couple deals you do, I think, and then just all throughout your process, if you work with a new operator, we're on the side of it always trying to get new business, but it's really risky for a fund manager to say yes to another group if they've got a couple they like already, because you're kind of going into a leap of faith of, hopefully working with a group that is in alignment with your values, but also meets your expectations of communication, meets your
Yeah.
expectations of processes, reporting, all things like that that really make up a deal that will either have your investors wanting to come back for more, or might give and call pause because you kind of put them or said yes to a deal that you perhaps shouldn't have. So the value of picking the right deals, picking the winners, picking groups that have the great infrastructure in place is so crucial. I think a big tidbit and takeaway I would have for anyone who's getting in the business is, if it's the first couple of raise, really do a very, very extensive and long deep dive into the sponsor that you're working with, but also make
Mhm.
sure that they've got their ducks in a row and that they are aligned with your values, because as you said, it's a 5-year relationship. And when we're looking for partners, the big thing we're seeking is not having one-off transactions, but a long-term, path to work with that individual. And, we have to earn their business time and time again, and on a monthly basis with the reporting that we do, and then also the distributions that we look to do monthly as well.
Absolutely. Yeah, the investor experience is ultimately the most important thing, right, in our business. And so having that communication piece, having an operator that performs well is just so important to be able to deliver that excellent experience to our investors.
Yeah, certainly. And on that end, we try to make everyone's experience, whether fund manager or investor, top notch. On our end, working with Lone Star, we take it very seriously. It's our kind of our duty to make sure that we go above and beyond for everyone. And not only is it about the investment, but it's about how the investment is ran and structured. I think Hunter Thompson has told this story time and time again. He once worked with 2 deals. They had 2 different outcomes. One deal did great. One deal did okay. The deal that went great, guess what happened? Terrible communication. Didn't know where it stood through the whole time, which means his investors didn't, and that made them uncomfortable, right? The deal that went okay had flawless communication. Well, guess which person Hunter and his investors wanted to work with again? It was the deal that did
Absolutely.
okay, but they had their hand held the entire time of the process.
Sure. Absolutely.
Yeah. So that
I
said,
agree.
Yeah, on that side of things, transitioning, how does someone, and, if you were to give advice to your younger self, if you were to kind of mentor someone, where would you kind of steer them? How would you get started in the real estate investing world and whatnot to educate yourself and whatnot?
Yeah, I mean, with today's technology, there's so many great podcasts. There's a ton of books. There's YouTube videos. All that stuff is free. You don't need a $20,000 course. Conferences are great. Great content, great for networking. How I got started very initially was house hacking, right? So you can buy a primary residence, live in it for a year, convert it to a rental. You can typically put 3 to 5% down on a primary, get the best interest rates, the best financing. Pro tip, that's easier to do if you're single, right? So it gets a little trickier once you're married and kids, and the wife's not wanting to move. So I did that a couple times when I was younger, and kind of kicked off, building a portfolio, and then was able to use the equity in those to buy other properties and started scaling from there.
Yeah, absolutely. And then you get in there, you start building up and scaling up the equity. So I think it's a really good, way to think about it and look at it. On your end, we're wrapping up the show here. How can people reach out to you to learn more about yourself and, investing with you and kind of learn more about the, Northwest Arkansas market that you're an expert in as well?
Absolutely. Yeah. Feel free to visit our website, daviscapitalpartnersllc.com. There's a link to schedule appointments. Also very active on LinkedIn. So send, connect, send me a DM. We'd love to schedule a session to find out, goals and challenges and how we might be able to help.
Excellent. Chris, thank you so much for being a guest. We look forward to hopefully working with you on a deal in the near term future here. For all those who are listening, we appreciate you and we'll hope to see you next week. Peace.
Thanks, Craig. Appreciate it.